What if I told you you could buy a property today that's already worth $50,000 to $100,000 more than what you paid for it? Well, in 2025, the key to success in property isn't waiting for growth. It's creating value upfront before you even settle on it. We're going to show you how wholesale property strategies can help you unlock opportunities that other people miss. I've got Chris McNulty here from Lucid Property Investments. He is an investment strategist, a complete pro, been doing it for 15 years, and he's going to take us through 3 proven strategies that are going to help you create instant equity in property. Welcome to the Buying Your First Home podcast, your personal guide through the Australian housing market. Here we tackle the big questions and the small details that come up when buying your first home. From financial prep to finding the right neighbourhood, we're here to ensure that you've got all the knowledge at your fingertips. So let's take the first step towards unlocking the door to your new home. Today, we're going to explore how wholesale property opportunities can give you an edge in 2025 without relying on risky strategies or complicated property developments. So, Chris, when we talk about wholesale property, what does that actually mean?
Well, talk about wholesale property. Like when I look at property, I see that there's really 3 types of property. I break them down into the first one being retail, which is your standard sort of house and land package sold by an investment group, all shiny, all the marketing attached to it. You're going to pay top dollar for something like that. Doesn't make it a bad investment, but you're paying full dollar, full retail prices for it. The second one is what I call vanilla, which is your standard just house or unit in the suburbs. Anybody can sort of go and buy themselves off the standard real estate agent. Again, not a bad investment, but it's not going to break any real records. And the third type is what I call wholesale. Wholesale for me is something it's a little bit more complex. There's more to it than meets the eyes. There's layers to it. The best way that I describe it to clients is imagine, Warren Buffett is out there and he's looking at this company and he's going to buy it for $500 million. He's buying it for $500 million because he's worked out that the underlying value of the business is actually $600 million. And he's done the research to determine that and had all the people looking at it, and they're confident to go, this $500 million business is worth 600. And that's kind of what I do when it comes to property, doing the wholesale investment strategies.
Yeah, because it's really, I guess, some of the stuff I've seen you do is like you're actually creating value at the time of purchase. You're not relying on the market. There's all these people talking about, you got to look at the data and the fundamentals and that stuff. And you look at that, but you sort of look beyond that. So why does it work? Like, why is it a game changer compared to just buying something in Perth and then hoping it's going to go up by 20% in the next year, crossing your fingers,
Yeah. Well, look, that's always been this strategy, is the hope and pray. Truthfully as well, like for the last 20, probably close to 25 years now in Australia, people have been fortunate that values have increased for pretty much every property asset. And so that strategy of just buy something, wait, has been effective. And I think it's made people lazy, and it's also made people expectant that will continue. And it might continue. But when I look at property, I think, well, sure, that's great. That's fantastic if that growth is there, but how about we do better than that and let's buy something for more than what it's actually worth? And so why it works is, I guess, there's 3 reasons why the wholesale strategy works. The first one is, and this is all contingent on buying the right property as well. It's not just great, I'll just go out there and do this. It's very much contingent on the exact right property. But the first thing is you end up with instant equity you've just described of it's worth more than what you pay for it. There's value in there that's higher than that. The second one is that the appreciation of the property is likely to be faster than what a regular house would be. The main reason for that being that if the underlying value of the asset is actually higher than your purchase price, the capital growth starts from the value of the property, not your purchase price. So if you've paid $800,000 for a property that has an underlying value of 950, the capital growth actually starts from that 950 rather than the 800. And so the magic of compound interest will sort of take care of the rest. And the third one, and again, this is super contingent on it being the right property, is if you're doing it right, undertaking a strategy like that should have not really any more risk than buying a regular house It should have the same sort of risk profile. Like it's easy. I think it's very easy to get greater returns in property. However, in doing that, I see most strategies involve taking much higher risks. And so for me, if you can do it without taking strong risks, then that's just a game changer.
All right, so that sounds great, like fundamentally, but like, what does it actually look like? You sort of like going to an old lady, like haggling her down, getting it under, like, yeah. What are some examples of this where, what does that actually look like?
It's funny. It's when you say haggling the old lady to get it on the market value, it's funny because it's quite the opposite. It's like, because we're looking at these properties in such depth, it's more often than not, they're just sitting there on the open market ready to go. And people are just not looking at it quite the same way. And so if something might look fairly expensive for somebody else at $900,000, but because the way we're looking at it, at $900,000, it's a steal. So I'll give you some actual examples of it. I'll start with, we spoke about 3 different types of properties, different types of strategies, and I'll sort of run through each of them now. The first one being sort of a regular dual occupancy strategy. And there was a property where we paid $780,000 for it. The rent on that house was, I think, $625 a week, which gets you I think the rental return on that was 4.2%, which is, it's not a crazy rental return, but it's also not bad by any stretch. So once we finished the dual occupancy project, we valued the existing house at $690,000 and the new house at $710,000. So we've got sort of $1.4 million of value. And then the construction costs on that, I think, were $370,000. So, or 380. And so we're looking at it and you go, all right, well, there's sort of $1.02 million in value there, a value uplift of, I think it was $230,000. So that's one example of it. Another example is using a future subdivision strategy. There was one down in Victoria Point that we recently purchased for $1.1 million. Once the client actually rented it, we got $1,000 a week. So that was 4.7% yield. So, just on its own, that rental yield is actually much better than what I find most properties are getting anyway to start with. So I think that was 4.7%. But with this one, it had a ability to do a subdivision where you retained the existing house at the front and built a block out the back. Now, the block out the back was probably worth $550,000. The house on completion of the project, it was quite a nice house with water views, worth about $900,000. So we've created assets there of $1.45 million. And then the cost to do that is about $150,000. And so we're looking at $1.3 million worth of value in such for a purchase price of 1.1.
I've seen those ones done over the years where, like, if you get the right block, you almost get the house at the front free. Like in something like that, like you're sort of buying it, you can sell, the house at the front almost for what you paid the original block, like, and you're creating that value up front. It's incredible. With
a lot of market growth and luck and stuff like that, that's definitely possible. And that's kind of the idea on it, is that value can be created over the long term as well. But it all comes down to buying it right at the start. There's plenty of opportunities where that doesn't happen. And most of them, like 95% of the properties we look at and go, oh, okay, like I can see how this strategy could work, but the numbers just don't work. And it's either, speculation is just rife, that people are paying too much for it, or it's such that the physical characteristics of the property don't really lend themselves to the strategy that we're doing. So it's an incredibly thin landing strip that we're working with here, which makes it terribly difficult. And I feel sorry for my analysts in the office of what I force them to do and how hard it is to actually identify the right property. But if you can get it right, it can really work.
Yeah, and there was another one you helped a client of ours with recently, a property in Brisbane for under $700,000 on 800 square meters that you can put a house behind. And the interesting thing with that particular deal was, like, you didn't necessarily have to develop it. Kind of like these ones you're highlighting, like there's nothing with some of the opportunities that you've been able to find with this wholesale strategy, you can just buy it as an investment. It's, $700,000 house in Brisbane, which is nuts.
Yeah.
But you can just sit on it as a rental. Like you don't need to develop it. But in 5 years, like once you've got the money, once you get the savings, you can choose to do that. So you kind of find these opportunities where you can make better use of properties, which is, that's why I really love some of the strategies you've got there, because they're much more creative and much more, there's a lot more you can do, more upside compared to just, like some of these people online that just go like, well, look at the data, buy an investment in Kingaroy with a 6% yield. Like you can't make better use of that. Like there's nothing else you can do than just rent it.
Well, yeah, it's interesting you say that as well. Like, we did this little exercise in the office. It was only a few weeks ago. And what we did was we said, for me and the two analysts there, we sort of said, whenever a Facebook ad comes to us that's claiming to have the hotspot secret, all of that, download it and then make a list of what the hotspot was, and make the end result of that project was that you could pretty much just throw a dartboard at Australia. Like there was no consensus whatsoever about where these hotspots really were, which to me, I don't know. It just, that's worrying.
It is. And that's why I think I like with some of your strategies too, like you become a bit of you're an area expert. Like you're not going all around Australia. Like you're sort of focusing in around Brisbane, right? Like around, specifically Brisbane, the zoning, what you can do more with. Like it's pretty interesting.
And that's what's given us the opportunity to be good at this and actually get the results, because we only focus on these value uplift type strategies. We've got very good at it. There's only really 5 or 6 strategies that we look at one time. We've got acquisition systems. So really our business is a research and analysis machine that we just happen to buy property out of the results of that research and analysis. And because we're so hyper-focused on these strategies, we've got that ability to look at a property instantly and just go, within a minute or two, we know what that's worth. And again, because we're so hyper-focused, we're looking at everything. We know all the agents. We see every single property that's there. And so we're able to sort of cherry pick the best ones.
And so on that, I think we went through the first strategy, obviously the dual occupancy, the second, the splitter. What was the third strategy there that you sort of look at?
The third was the rooming accommodation, and that's no secret out there that everyone's doing rooming accommodation. And look, to be fair, the first 2 strategies aren't exactly a secret either. Like that property at Victoria Point I explained, like it was no secret that you could do the subdivision. It was sitting there in the ad. It was one of the first things about subdivision opportunities. So it's not like I'm knowing that these properties are subdivision opportunities when others don't. Almost all the properties we're buying, everybody knows that that's the use. It's just the way that we're looking at it and our understanding of the numbers that changes it. And so rooming accommodation is another really interesting strategy. I'm not sure if you've spoken about it on the channel before, but rooming accommodation is essentially a house that has 5 separate studios that are somewhere between 30 and 40 square meters each that people live in, single occupancy sort of stuff. And it's designed to be a step above a share house. But what's great about it is because there's 5 rooms in these houses, you can get much greater rents. So we're talking sort of $400 a week for each house each. You can create an income of over $100,000 gross per house. That nets out to be, once you take away costs, probably somewhere in that 70s, maybe 75,000, 80,000, depending on where the rents are at. And to create that, you want to go buying a block of land, say $650,000, building a house on it for $550,000. You've got costs there direct of $1.2 million. And so from those $1.2 million of costs, the value at the end of that is, we're seeing prices at the very low end being $1.3 million, and then we're seeing $1.4 million in the up. And so there's this value add opportunity where you complete the project and the property is worth $200,000 more than what you've done. And, that's in contrast to a strategy that's somewhat similar as I look at like the dual key thing, and there's a lot of those out in Logan and whatever. And it's like, they get really good rent. You can build one of those for probably $800,000 or so, maybe $850,000, $900,000. I don't know, because I don't look at them. I don't think they're particularly good investments. So I don't have the numbers that clear. And you might get $1,000 a week. But the trick with those that I think limits the potential is the end value on completion is still only 850, 900 what you've paid for it. And so, yeah, you're getting better rent, but you haven't actually created any value.
And I guess that probably brings us to like some of the mistakes you've probably seen people make over the areas. Like I see it where people sometimes just buy because of a price point. Like, oh, I can only afford to buy something for $300,000. So you go really far in regional, not looking at the fundamentals, possibly overpaying. Like, what are some of the mistakes you've seen people do in these strategies or just generally, like, when they're investing?
Definitely, I think the you don't know what you don't know principle is the number one. I see, especially in development style I call them development style properties, but properties that have got some sort of development potential. I see a lot of people, and I say industry professionals as well, look at these properties and see that development potential, and they look at it in a way that is suggestive that it's a feature of the property. That it's like, oh, this property is great because it's got a pool, it's got a view, and it's got future development potential. Like there's this zoning in Moreton Bay called Next Generation Urban, and I see that a lot. People are just, oh yeah, we bought it and it's got this future development potential. But it's like, okay, but is that relevant? Like you could knock over a $500 million office building and rebuild it, and it's technically a development site. Obviously, you wouldn't do that. And I guess an example of that is you think about, I don't know, imagine this fictitious house at Everton Park. It's a half decent house. It's on 800 meters of land. It's $1.5 million. The blocks of land, once completed, are going to be worth, say, 700, probably a bit more than that. But for argument's sake, we'll say 700 grand. So you've got $1.4 million is what the end value of that would be. Then you've got to do a subdivision that's another 150. You're down to $1.25 million on a property that you've paid $1.5 million for. And you go, is that actually worth anything at all? And the answer is no, not really. And so that's why I say 95% of the properties that we look at are like that. And that's why I want to caution so much that this wholesale strategy is not a magic trick. It's not oh great, I'll just buy one of these wholesale properties that Chris spoke about and we'll be golden. It's not at all like that. And yeah, I'll give another example if you're interested, that I think will really explain it well. And this is actually a real life example. I had a client buy a property for $650,000 at the dead of COVID. It was a time when you could really pick up sites for good value. He then got his approval to do a 2-lot subdivision on it, and he was planning to go and do that subdivision and sell it. That some blocks next door at that time, such as the property growth in that time, 3 years later, was selling for about $650,000. And so if you go, all right, those blocks at $650,000 each, $1.3 million, because he'd had the approval, let's say be kind and say it's 100 grand to do the project. So you're down to $1.2 million. And so if he was to sell that for $1.2 million, it would have been an amazing return on the 650. However, he got a phone call from an agent saying, oh, we've got this buyer that's looking for a subdivision property. Is yours for sale? And he and I spoke about it, and I was like, well, see what they say. Came back, through some negotiation, they ended up offering him $1.25 million for the site.
Jeez.
Which he obviously took. And you go, right, so somebody just paid $1.25 million for that site, then paid another 100 grand to essentially create blocks worth 675 and had to do the work to do it, the extra holding costs, whatever. And they could have just gone next door and bought blocks for 650. And you go, those are the mistakes I see. It happens all the time. And it comes from a mix of simply just not understanding how property works. But then secondly as well, just misvaluations and misunderstanding of costs. Someone might say, how much does it cost to do a subdivision? Oh, infrastructure charges are 35 grand. And, what do you do? Got to connect some services. Might be 60K. Yeah, those are the mistakes that I see people make.
And that's what I like, I guess, where you add value is that, A, you're an area expert. Like, in the Moreton Bay Council what you can do, in Redland, in Brisbane City Council. And I think that's a big mistake people make, as well as not being clear on their strategy. So, and that's one thing I know you've helped clients of ours and people in the process is you'll sit down and be like, well, here's all the strategies. Like, what are you wanting to achieve? What do you want to do? Do you want the cash flow? It's where the rooming thing might make sense. Are you wanting capital growth? Do you wanting that value straight away? The splitter might make sense. Are you wanting something you can hold and extract value? So I guess one thing you say, and there's so much going on, but you say complexity makes opportunity potentially. It's one of your big sort of core principles. I guess what do you mean by that? How does it help?
Yeah, it's the core thing with what I do, and complexity equals opportunity. And I'll try to explain it without taking too long. But the complexity equals opportunity thing is essentially that if you imagine, say you go into a new land estate, right? You're in a new land estate. All the blocks of land, more or less, are similar. There might be some with views. There might be a slightly bigger land area, whatever. The width might be a little more. But in short, there's been so many sales, so many properties for sale that the way to understand the value of that is pretty easy. I remember when I did my property economics degree, the first valuation subject we did, they sent us out to Forest Lake when it was actually being developed. And we had to value a block of land. And they did it because it was just so simplistic. It was so obvious. And nobody could really get that wrong. And so that's where we started it. And again, it's difficult to get that wrong. And the potential variance in the value, because it's so simple and obvious, is really small. Someone might look at that property and go, oh, that block of land's worth $510,000 at the low end. And then someone else might say it's worth $530,000 at the high end. And so based on that, there's not a lot of room to get a bargain. There's not a lot of room to get a deal, because even if you do really well, you're only going to save yourself $10,000 or something. Now track to a far more complex property that's got some sort of physical development constraints. It's got multiple value drivers going on. There's no direct comparable sales whatsoever. Even the value of the stuff on completion is a little bit finicky and unsure. There's going to be a massive range as to what that value is going to be and how someone's going to see it. And so, someone might see it at the lowest point and go, oh, that's only worth $700,000 to me. And someone else could look at it and think, and making incorrect assumptions, could say, oh, that's worth $900,000. And so that's the core principle of my entire business is we just sit there and we are just an analysis machine. And I said that earlier, and I'll run you even through the simple 3 steps we do is, step 1 is identifying which strategies are even possible for this stuff. The second one is doing all the research and analyzing all the properties to determine, well, what's the criteria that would make this a good one? And understanding the value. And then the third part, and that's why I'm even reticent to really even call myself a buyer's agent or anything like that, because it's I'm really just picking the right property and going, this is the one. It's much more, I'm just a researcher. And so I'm going, okay, here's the best one. And if you're understanding the values and the research to such extent, it's just so obvious which are the ones that are at that bottom end of the value range that represent really good value. And then we go and buy those ones for our clients. It's simple, the idea of it, the execution of it, obviously a lot more complex, but that's kind of it. And I think that makes sense, right?
Well, and I think also the bit that people miss, and I'll have people contact us yeah, I found the best deal, just come across something, they find one deal, they're ready to pull the trigger. But in reality, I'm sure your team is trawling through tens or hundreds of deals before you find the right one. I met a property developer in Sydney. He said he bought one site this year, but went through 50 to get to that one site. It just takes that much time. It's a lot of number crunching. And I guess that's where you can help compared to someone on the street trying to do it themselves. You can definitely do it yourself, but it's a lot of time. It's a lot of analysis.
And you're competing with me. Yeah.
That's the thing. Yeah.
Yeah. And that's it. It's hard because we're experts at it. We only do this. I've got a team of 2 analysts that are in there all day, every day, just crunching numbers. We've got these Google Sheets that are just full of every property that comes on. The minute that property comes along, we're analyzing it, looking at it. off putting offers in if we think that it's worthwhile. Same with the off markets. We're in contact with all of the agents in our areas. I've actually got a guy that full-time is just pretty much sourcing off market properties and doing that. And so, we're only able to create these outcomes and get the best ones because the volume of properties we're looking at is so high. Like, I have a lot of my clients come and say, like, how do you even find these? And that's the kind of the mistake that it goes to, is when they're so hard to purchase, people look at them and they think, oh, I've finally found one that matches this criteria. And it's almost like this relief. And it's like, oh, great. I'll just get it for the best price I can. And it's like, well, no, sorry, you should have looked at 50 of these to get to the one. And we're probably not at that point of looking at 50 to buy one, but it's probably 25, 20 to decide the right one. And each of those 24 that we reject, someone else has bought it, most often thinking, oh, great, I've got this, future development thing. This is going to be great. And I go, oh, like we often say in the office, we'll come in on a Monday and look at the sales that have happened on the weekend. And we'll go, who the hell bought that? Like, you've got to be kidding. Like, what were they thinking? Who is advising them? Scarily often it is buyer's agents who go, oh, it looks like a good property. Yeah, future development. Can't go wrong. You can. You really can. So, yeah.
And so I guess tell us more, like I've worked with you a bit with clients, and like I'm always reluctant with buyer's agents. Like, a lot of people advertise, we can get off market. And I genuinely believe with most buyer's agents, like, that's not true. Like, if there's a mum and dad trying to buy a house, like, a lot of it's on market at the moment, unless it's multi-million-dollar properties, like, it's on there. There's not that much opportunity for off market in certain segments. In your segment with developments, like, I've seen it firsthand, you actually do get off market deals before they're listing to sort of run your ruler over it. But yeah, I guess tell me a bit more about Lucid, like how you guys help, how it works, and how people can get in contact as well.
Yeah, look, we're a 100% referral-based business, and that's always how I designed this. Like, for me, it's really important that I have a business where people trust me enough to send clients my way. So based on that, I have a pretty low digital footprint. Our Instagram is pretty much just says, we don't do Instagram because we're spending our time doing the deals. Our website's probably the best place to get in contact, and that's lucidpi.com. So Lucid PI for Property Investments. Similarly as well, if you're listening to this and wanting to understand a little bit more about the way that I look at properties and the concepts that I use, I've written probably a dozen or so essay-style short pieces on LinkedIn that you can go and look at. And if you're an investor looking to pull the trigger on something and wanting to get better than market returns and start ahead, get in contact with us and we'll help you out.
Yeah, we'll include all the links below. Like Chris said, it's investing. So if you're a first-time home buyer trying to buy a house to live in, not Chris's sort of clients, it's if you're an investor looking to grow, looking to beat the market returns potentially with some of these wholesale strategies, like really powerful stuff. Definitely recommend checking out his LinkedIn. It's got a couple of recent deals he's done as well on there, which are just like crazy. Like, and it's stuff that happened this year, 2024. It's not things from 5 years ago that some buyers agents will advertise, and they bought something in 2019 and it's tripled in value and stuff. Like, it's actually happened this year. So yeah, I hope you got some value out of that. I'm going to include all the links below to Chris. Thank you so much for joining us, mate. And yeah, until next time, we'll see you guys.
Thanks so much.